So I want to start this particular live stream with really a question, and that is today the day, or is this portion of this economic cycle the time to get greedy, or is it time to be afraid? And the reason I ask that is I'm always stuck with I think it's a Warren Buffett quote, right? I get greedy when others are fearful, and I'm fearful when others are greedy. And I say this because, we do this every day now, right? So you kind of get a feel for what's going on. And, we're in a pretty good spot right now, right? I talked about it, I think the first time like 10 days ago or so, where things were just set up. It started with the talk of a trade war phase one agreement. Then UAW and GM kind of got together and, put it into the strike. Then the Fed came in and gave us a point rate cut. Employment looks strong. Consumer spending looks strong, or at least healthy. And, it seems like we're set up to really end the year, to go into the holiday season on a high note. But anytime in my investing career where everything seems lined up, I generally get nervous. And that's because when I was, well, I don't know, 2 decades ago when that happened, I kind of moved my chips to the middle of the table and didn't work out very well. So it's been a constant reminder. So I just want to ask, right? When you're out there and you're looking to invest or put money to work, just step back and ask: Is everyone doing this, or do I? That's the idea to think about today, right? Good old Warren Buffett. When others are greedy, I am afraid or fearful, and when people are afraid, I'm greedy. So, all right. So on to other topics. First and foremost, it looks like Xerox is going shopping. It looks like they're doing a stock and cash deal to potentially buy HP. If you don't know, I actually worked at HP for a long time. Back even before they split up, they created a HP printing company and computers, basically. And then they had that whole technology thing, servers and software split off, and then they sold software and basically destroyed the company. But it looks like the frankly the legacy part is going to be sold, or at least, yeah, it looks like it's going to be sold to Xerox. So Xerox is going shopping. And this again is something we've talked about. I told you this was coming, right? When debt's cheap, and growth is hard to find, companies go shopping. So just the latest example. Uber, looks like their employee lockup is today. If you don't know what that is, essentially, usually it's 6 months after a company goes public. The insiders, the employees, they can't sell because they don't want to flood the market too early or whatnot. Well, that ends today, and some of the numbers I found are pretty striking. First off, up to 90% of the 763 million shares that were locked up could potentially go be sold. So that's a lot. They actually expect about a quarter of that to be sold here shortly. The other thing I think is interesting is the company went public at 45. It's been trading, as low below 27. So down, I don't know, what is that, 40%? So what I wanted to talk there is I'm just curious, how many employees do you think had eyes of a new car, a new house, a new vacation, a second home, heck, and now are having to slash those expectations? These are things that are really happening out there. And I think a lot of what's been goosing the Bay Area housing market is receding and receding rapidly. And I believe there's going to be pain ahead. Just another example, right? I mean, the employees who have been looking, they probably circled this date on their calendar. Like, wow, what a great time to be unlocked right before Christmas, blah, blah, blah. And they were probably going to open houses, doing all these things, and now, the stock's down 40%. No, not as rosy picture. So I think that's going to be happening a lot. Another thing I read is Chesapeake Energy, right? Energy companies, at least this one, Chesapeake, who was predominantly natural gas, is they actually released something saying they're substantially in doubt that they can keep performing. And that's because they're drowning in debt, right? $10 billion in debt. They did a $4 billion acquisition to try to diversify, get into oil, but that's not really working out well. Debt does have a downside, and this is debt that's probably really financed with low interest rates. But the commodity that they're known for is oversupplied, and frankly, they brought it out because of fracking. This is what they're really known for. So they found another way to squeeze that fruit, if you will, to get more natural gas out, and now there's an oversupply, and they can't fund their operation. So it's interesting to see, and I don't think Chesapeake will be the last company that admits they have too much debt. I think the government has too much debt, frankly, and I think there's been a lot of companies that took on debt over the last 5 to 8 years through this growth cycle that used the money badly, and there's going to be a lot of people that go out of business or be sold for parts or whatnot. Airbnb suffers what I call another setback. We talked about Airbnb a week ago, maybe two, about Santa Clara, right? A local county or city saying no thanks, basically, no short-term rentals. Well, it looks like Jersey City residents voted uh, against allowing Airbnb, and obviously Jersey City. Again, I don't know exactly where it is, but I think it's right across from Manhattan. And if true, I assume there's been a lot of people investing in Airbnbs for Manhattan market. And basically, they're saying, nope, not in our backyard. So that's going to do a couple of things. First off, it's going to hurt investors who probably already bought and are, doing that. But more importantly, I think this is a dangerous precedent for Airbnb. Airbnb is, expecting to go public next year, early next year, I think. And, I don't know if we got another Uber and WeWork on our hands because, pretty soon there's going to be no major markets that kind of allow it. And if there's no market, is there a company? So I don't know. It's kind of scary. Another thing I just found, sort of wrapping this conversation up today with you, is looks like the S&P 500 earnings, forward-looking earnings, is once again dropping. It peaked at 14% about 5 quarters ago, but now it's down to 1%. And obviously, forward-looking or earnings expansion is important because that's really what stocks should be valued on. Now, we all know that sometimes it's emotion, but really, stocks really should be a fundamental. It's uh, it's fundamental. Thank you for tuning in, Jason. Uh, S&P earnings expansion at 1% should be a fundamental valuation of what a stock is, not historical. It should be future. So at the end of the day, if the expansion is now down to 1% and threatening to go negative, what does that really mean? So in the end, I go back to how we opened this up. Should we be concerned that we seem to have everything set up in the right direction? Or should we be getting more conservative, looking at everybody else getting really happy at the party, right? Drinking just a little bit too much. So that's where I'm kind of sitting. I want to hear from you. Let me know what you think. Again, Xerox goes shopping. Uber unlocks today. Chesapeake Energy is drowning in debt. Airbnb suffers another setback. And of course, all important S&P 500 expansion is earnings expansion is down to 1% and threatening to go negative. All right, everybody, have fun. I think we have 3 interviews today, so that should be fun. We'll see if they all happen. And at the end of the day, take care, and we will talk tomorrow.